All right, episode 11. Today we're going to admit something that we were wrong on. So you're going to want to find out and tune in all the way through because we're not wrong often and we don't like to admit it.
Eating crow.
We're eating crow for sure. And we're going to get started on the More Doors podcast right now. All right, welcome back to episode 11. Today is one that probably all of our partners, our spouses, our wives, they're going to want to tune in because we don't like to admit when we're wrong on anything.
Doesn't happen often.
No, it doesn't. So this is your first time listening to the More Doors podcast. Welcome. You're definitely going to want to check out the other 10 that we have so far. Leave us a review wherever you're listening from and consuming this. If you're on YouTube, subscribe. Leave us a comment. Yeah.
I hope our wives and significant others are watching this, just because we can do it on the show. But I'm sure you've been in this situation before.
I mean, I get told I'm wrong a lot. I don't know if I actually am
Every
wrong
once in a while, you'll have that moment middle of a conversation with your wife, and you're just like, oh no, I am super wrong about this. And but then you just have to die on that hill.
Yeah. It's like you
can't admit it.
And you start to stutter a little bit because you're stuttering because you're trying to find you're like, all right, how can I spin this?
Exactly.
Right. And that's when I get told, don't client me.
Yeah.
I'm like, I don't do that to my clients, by the way. I would never do that. But look, today's show is brought to you by our favorite partners, our sponsors, Deep Blue Capital. It's Deep Blue RE. If you want, go to deepbluere.com. So if you want to find out more about investing in and looking at projects that could help you, maybe you've got some money that has come in, maybe you've inherited that, and you want to put it to work, and you don't know where you should be placing that money or how to grow it, right? The stock market's all over the place. You know, everyone thinks they're financial gurus right now, and when you look at it, they don't really have any money. Yeah. So just go to deepbluere.com, sign up, and you'll see our list of projects that we have that we're working on, that we've already invested in, and it will go over how well those projects are doing. I like that part. So,
100%.
And then, of course, I always like to promote, this studio, Tor Studio. Go to torstudio.com if you want to create your own podcast or video reels or whatever. So thank you, Tor Studios, for putting this on.
Tor Studios.
And if you tell Jesse he's got the best beard ever, I hear there's a small discount.
There is.
Just saying.
Yeah.
Not
like
much, but something.
Use promo code best beard ever.
Tor Studios has doubled their client list this week.
That's right.
Nice.
That's right.
Outstanding.
So congratulations,
Congrats, Jesse.
And so episode 11 here, what we're diving in is that we were wrong. If you go back, I'm trying to remember what episode that was when we talked about kind of the looming problem in the marketplace. It's probably like the second or third episode, I believe.
I think it was when Brian Gramlich was on, right? That was like episode 2.
2 or 3.
Episode
And it's something that everybody's been talking about in the space for a while. Ever since rates started to really pick up and the people that were trying to potentially refi out a bridge or whatever, like, they're not able to get the refi. They're not able to get the rate that they needed to make the deal work.
Or the leverage.
To make the deal work. And so that's kind of been a huge conversation for a while.
And by the way, I still think there's that risk out there. So I'm gonna say we opened the show saying that we were wrong.
Uh-oh.
I don't think
I
don't think we were actually wrong.
Yeah.
I think we had an incomplete statement. So there's that, right?
We omitted.
Yeah. And just to clear up the confusion here for people scratching their heads saying, why am I listening to these guys saying that they're wrong? Our thesis up until today has been that a lot of deals out there on bridge debt were going to come due later this year, and those deals didn't really have a proper exit strategy, right? Rates have gone up. Chances are the underwriting assumptions are now invalid. And between rates going up and lower leverage products available from agency, that those folks were either going to need to sell or, if they could, extend with their bridge debt fund.
Yep.
Right. I still think that's a problem. Yes. Although we have a deal on bridge debt, and the lender has been very good with us.
Yeah.
And we're going to extend.
Yeah.
I'm sure there's other people out there, right?
That's the thing with that. Sorry, the thing with that problem is that if all of those deals blew up at once, the lender just couldn't take all those assets on at the same time. So they have a real vested interest in trying to figure out solutions.
Exactly.
Yeah.
Exactly.
Look, logically, it makes sense
Right.
when you're talking over like, no, like it's not going to pencil out. You're going to have all this distressed assets, and it's kind of like in the residential side or even in the commercial world right now. The banks don't want to own it, right? It's not good business for them.
That's right.
And so, where we're seeing it, Brian and I are actually in a project together that we are LPs on, and we're starting to see a common theme on some of these updates that we're getting is, hey, we're pausing distributions, right? And the financials overall look really good. But here's the concern that we have. The concern is that we had a 5-year plan, and we have what was it, like a prepayment penalty on that one?
If we were to lock fixed, you have
Yes.
a substantial prepayment
Yes.
penalty, right? Because and this understandable from the lender side, if the lender is getting very little interest on the loan, they need that loan to work for them in perpetuity as long as possible so they make money. And so they're going to charge you an exorbitant amount of money to pay the loan off early if you're getting a 3% loan. They need you to keep that loan as long as possible.
So in that project, it penciled out really well. It was a great. It was like a grandma deal that you would have gotten. Like if grandma's giving you her deceased husband's car that's only been driven 21,000 miles, and she's just here's it for $500. You can have it, Brian. And it was kind of
Just
this.
give it to me, Grandma.
Yeah.
What do you need the money for?
It was, but this was what it penciled out to be a sweetheart style deal, and they did not take the locked in fixed debt, and so they just took a floating. Now, with that, they had this. They purchased the rate cap lock on it, and so it's like, okay, everything's good. If interest rates were to go up, because then that was in 21, it wasn't really on the radar. They had talked about it, but everyone was like, oh, if it goes up, it's going to only
Like 5.
Yeah, 5, maybe 6%.
Right.
And when all of a sudden, and what was it in 22, when rates just started going haywire?
May of 22 was the first Fed hike. Was that right, Jesse? I think it was.
Yeah, something like that. So somewhere in that middle part of 22, and then rates just took off. The email the update we got was, hey, we're going to pause distributions. We just want to stay healthy. And we're like, okay, cool. That's great. But our concern is that the company that we purchased this rate cap through, they might be insolvent.
Yeah.
And we're like, okay.
There's only so many counterparties in that space. And so if you have a ton of deals that are all aligned with these counterparties buying rate caps, if they have to exercise that all at once, that could be a problem.
Yes.
Right.
And so now, the company did not go insolvent, which was great.
Yeah.
But, some of the most recent updates we're getting is, hey, we're going to look at, and we're starting to see this a lot with other people's projects as well. I was talking to a good buddy of mine who's with another company yesterday, and they're experiencing the same thing. And they're getting calls from other operators asking, they're all just starting to, kind of mastermind together on this. And the kind of the game plan is, do we sell it now and do an early exit?
Yeah.
And what would that look like? What are the returns for the investors? Are we able just to get our capital back to the investors? And, sometimes that makes sense. It's better to, just like playing blackjack. Yeah. It's better sometimes to take a push than a loss.
Yeah.
Just don't lose money.
And then the other two items is they could do a refinance to fixed rate. But if they did that would require a capital call. Yeah. Or do they extend in another year or two? Do they extend their cap rate lock?
Yeah.
And I think
Rate cap lock.
Rate cap lock.
Got it.
Yeah, I always get them.
I wish we could do cap rate.
Yeah, I
lock.
wish we could lock cap rates.
That'd be great.
Ooh.
6 going in, 4 going out.
How do we start? Who can we get financial?
I bet you there's
geniuses
somebody on Wall Street that can help figure that shit out for us.
Yes.
Just ask ChatGPT.
Yes. That's a newcomer. We just started that.
Right.
So,
DeepBlueDerivatives.com.
yes.
There you go.
The guy with the GED is a partner in that. But the next part would be, do we extend that the
rate cap, yeah.
the rate cap on it? And if we do, the cost to do so is now 20 times that, 10 times that, 15 times that. And
Wow.
guess what? If they do that, it's going to require a capital call.
This is
So let me see if I summarize this correctly. Right, you guys went in as LPs on a deal.
LPs.
It was a sweetheart of a deal.
Yep.
The business plan's been executed.
Yeah.
It's
and
looking
the-
great, by
there was
the way.
a-
we
was
raised rents more than we thought we would.
Okay.
The occupancy's there. We've gotten through all the turns, 100% renovated. That part has been executed perfectly.
Okay. But now they went in with floating rate debt. They bought a rate cap. The rate cap is coming due to expire soon.
In a year and a half.
So you still have a year and a half left?
Correct.
Okay. So the rate cap's going to expire. So now they're looking at exit strategy and say we can renew the rate cap, but it's going to cost us somewhere between 10 and 20x more than what we paid originally.
Yep.
We could refi, but because rates have gone up and leverage has gone down, if you're going to do that, if we're going to do that, they're going to make a capital call to you guys.
Well, plus we have the prepayment penalty.
Right.
Or no, we don't. We still have a prepayment penalty. I don't think it's as much.
It's minor.
yeah.
Okay.
But, yeah.
Or you can sell.
Or sell.
Okay.
Yeah.
Yeah.
So now, just a question, right? You guys as LPs on the deal, I think you guys have you know this particular operator, overall good guy, knowledgeable,
great
the
guy.
whole thing,
Yep.
right? But you get that information, and like, how does that make you feel? Sorry to go therapist
No,
on you,
it
but
doesn't.
No, for sure.
Here's the thing, for any operator and anybody who's an operator listening to this or an LP or aspiring operator, transparency is key in all situations, right? This is not the only deal that's not going according to the plan
True.
right now.
Yeah,
we are
absolutely.
in historical economic times. What's made me feel good, because this is not the only deal that we're dealing with issues on. I have distributions paused on 2 other deals as well, with very solid operators that I trust. They've been, especially on those other deals, they've been wildly communicative. And, I understand enough about multifamily investing that I'm not freaking out, because if I had never done a deal before, didn't know what any of these terms were or the strategy was, all I know is I'm not getting paid right now, I might freak out.
Sure.
But I think that when you explain things, really well, and you're very transparent about it, and you give regular updates, your people understand, and they feel quite a bit better. I will say the one thing that I have seen becoming more and more prevalent in some of these deals where we're trying to figure out an alternative strategy now is, and I told Nick this yesterday on the phone, the one thing that I am disappointed in with operators all over, kind of at large, that utilize this strategy is, it's my personal belief that you should always align every aspect of your strategy with the business plan, financing included. And of course, we didn't know that rates were going to increase at the fastest rate in human history. But I also think that's beside the point. My thesis would be, if I have a 5-year plan, I need to get the financing product that aligns most prudently with that 5-year plan. And if I'm going to select a financing strategy that is better if we dispo early, then I'm not actually aligning the financing with the business plan that I'm advertising to my investors.
Which kind of, like, again, to go back to 21, and this is actually, I'm glad we're breaking this down. We go back to 21. It was a 5-year plan that talked about selling in year 2, though.
It did.
So
Okay,
so I think that's the reason why they had that plan.
This operator is fantastic,
yeah.
and he's very, 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 very knowledgeable, and that's true. That was part of the original conversation. I guess I should say, I always think those things are gravy. You know what I mean? So it's like protection first, defense then offense. I always think.
Yeah.
Because yield maintenance, prepayment penalties back then, it's kind of like on some of the deals that I have. Like, I couldn't sell some of my things back then because I had a very large prepayment penalty in there. And as rates went up, thankfully my prepayment penalty went down because it was based on the yield, on the treasury yield, and it wouldn't have made sense probably for that operator. He was, what they were looking at. All right, if we exit in year 2 or 3, the prepayment penalty on that one would probably wipe out a large portion of that
gains.
nets.
Yeah.
So it didn't pencil out for them on that one.
Right.
And I get why they did it. I understand it. And we're now in this market, and the way that we need to underwrite, or the way that we should be looking at any future projects, is to say, what happens if it goes to 8, 9, or 10? Because we're at 7.5 right now.
Yeah. And we never thought we'd be here this quickly. And I will tell, like, it's become more and more apparent over the last year, right? Like, we all have become way more attuned to what's going on economically in the Fed and all that type of stuff, way more than we ever have in the past, just because it affects so many deals right now. But I think it's just become so much more apparent over the last year that, like, all the forecasts and analysts and all that type of stuff, you understand that, like, financial analysts are the same as sports analysts on ESPN. They're doing a good job in their own way, but they're there to entertain you. They don't know what's happening.
Yeah.
They don't know what next year looks like.
Agreed. So, question for you guys, right? And I don't know if you know the answer to this, but if you roll the clock back 2 years, why was the decision made at that time to go with floating rate debt and a rate cap, as opposed to fixed rate debt with the possibility to assume it?
It's a good question. I don't think
you know,
we
like
know
the
that
prepayment penalty is very real if you're going to pay off the old debt and get new debt. But in a situation where you're getting a rate cap, you're kind of assuming that rates are going to go up.
Right.
So why not just say, I'll take the fixed rate with the prepayment or the yield maintenance, as long as if I sell this, the buyer can assume my 3% debt, which would probably make my deal look a lot better anyway.
Sure.
Yeah, I'm wondering if the costs associated with going with an assumable product were higher, just because, you know, then the bank is still allowing somebody else to come in at a very low rate for an extended period of time.
Or does it eliminate the refinance option in less than 5 years?
Yeah,
so
maybe, because I mean, I've underwritten some deals. I think we've reviewed a couple of them where it's, you know, and I'm making it up. It's $10 million if we assume the deal, assume the debt, and it's $10.5 million if we're going to take out new debt because there is a prepayment penalty and the seller's not going to eat it.
So I'm selling some of my developments, and that's how we offered it up, right? So I have one that I just executed an LOI on, and that buyer would go off of the assumption. And they're taking down another opportunity as well. So their blended average is looks good.
Yeah.
But it was, if you're going to buy it here with not assuming, then it was about $450,000 more.
Mm-hmm.
Yeah.
Because we were building in that yield.
You have to, right? And I love those deals, right? Like, as long as I know what here are my options and I can negotiate down from there as necessary. But I'm very interested in you know, I'm not trying to open any wounds or anything or roll back the hands of time, but I'm like, why, if I'm just thinking about it logically, if a rate cap was put in place because the rates were assumed to go up, why not just take the fixed as long as it could be assumed? And then I guess you're kind of assuming that the next buyer can raise the equity difference and stuff, but that's kind of like the next buyer's problem, right?
Sure. Yeah. It's great. And we always learn, we always learn by going back and looking at these. You know, and the good news is that anything we analyze, and Matt, you can relate to this when dealing with us as partners, is that we look at everything in the most skeptical, negative at times ways to protect anybody else's money, because we're in these deals now. We're in deals that are you know, that are paused. We're in deals they're in limbo. And the number one goal is not, you know, the number one thing is not to lose money, right? Not to lose the investor's money as well.
Yeah, absolutely.
And the operator on that one's doing everything they can. We have full trust and faith in that operator.
Yeah, I think we're gonna be fine there. And here's the thing: it's quality asset. We've raised rents and in line with the business plan and all of that. And going back to, you know, why this all matters and why, you know, we said we were wrong or omitted is, you know, that is a deal that the business plan, from my perspective, was executed really well. And because one part of the financing wasn't in line with really historical macroeconomic events, now it's in limbo. And so where we talk about the hidden kind of time bomb that we were wrong about, I have no idea the data of how many deals are facing this. But
I was about to ask, can we go pull that?
I was like, you'd be the guy.
I mean, I can ask around.
Right?
Yeah, think about that, because the way that this podcast came about, originally we had a guest slated today, and it got double booked. And so as we're coming up with episode 11, a little bit on the fly, but it's not, because it was like, hey, this is something we experience. and it was yesterday, not just experience what Brian and I just shared and talked about, but on some deals that's been being analyzed.
Yeah. So just to get everybody up to speed, like the same thing happened twice within a few hours of each other.
Yes.
Right. So we're underwriting a deal. We're on a call with a broker that we know well, right, and on a property that pencils out very, very nicely, and we're going through a rate cap exercise, and we see that the rate cap in today's environment is exorbitantly high. And we come to find out that the current seller, or the current owner, I should say, the seller in our case, had a rate cap in place from when they purchased the property about 2 years ago. And that rate cap is a few months away from expiring. And the difference between, or the multiple, I should say, between the rate cap that they paid for versus what that same rate cap would cost today is 20x different.
20 times as expensive.
It's 20 times more expensive today than it was 2 years ago. And, they put a lot of money into the property. It looks good. There's still some opportunities to drive some more value. But if you didn't account for that in your original underwriting, you can't make that happen. So we're sitting here saying to ourselves, you guys are hearing about it from the LP perspective. We're staring down the barrel at this on potentially another acquisition that we're trying to do before the end of the year. How prolific is this problem?
Yeah.
Right? And
let me ask you, Matt, hold on real quick.
Because
you said unless you underwrote for it, how many operators do you think actually took in account that it was going to go up 20-fold?
I don't think anybody.
No.
Right? I mean, between we've talked about insurance, we've talked about property taxes. Those are things that have gone through the roof. And you can adjust your underwriting assumptions on that and potentially just lower your distributions as opposed to wipe them out.
Right.
But 20x difference, the difference between 28,000 versus 560,000,
yep.
Like that's drowning.
And the fuse of that bomb is these rate caps are coming up for renewal now, and either you have to dispo the asset, renew, which would require a capital call, or let the rate cap expire and just now you're adjusting to market rate. Who knows what that looks like?
Right.
And so as people looking at deals, we're watching this happen in real time and we're going, how many deals out there are the GPs facing this same problem?
Yep.
This particular asset's been shopped for a while.
Yep.
Because I think the GPs probably started to see this problem develop.
Agreed.
A little while ago.
Yeah.
Because you've got to, and correct me if I'm wrong. I thought I heard this probably. You've got to start escrowing your payments for your renewal during your hold.
That's right.
And so they see their premiums going up, and it's an automatic draw. And so if you don't renew, you get that money back. But if I'm a GP and I see my renewal payments start to go up that are getting escrowed every month, I'm going, we've got a serious problem.
Yeah. There goes cash flow. There goes distributions. There goes any sort of returns, right?
Yeah.
All of it just gets sucked out of the deal.
And if we don't renew this thing, well, then, maybe we end up at 8.5% or something like that, and we're completely uncovered.
Well, so if you were to do that, so if you were in that position, do you run the numbers like, all right, it goes up 20 times that, and if you break that down, how long is a typical extension? Is it 2 years?
The one we looked at yesterday, you could buy it from 1 through 5 years. Yeah. The longer the term and the lower the rate, the more expensive it was.
So the 20 times one was 3 years, I think, right?
So
if we were to break that down over 36 months, that's about let's call it $13,888. Would it be more advantageous just to say screw it and let the rate go up? That's where you start running those numbers and say it's not worth that. It's better to take the hit.
Yeah.
And then look at and use that escrow build up to maybe just go and refinance it into somewhat of a lower fixed rate debt.
Potentially, right?
Yeah.
That is the gamble you take, assuming that refinance isn't going to wipe you out from a cost perspective and rates are actually you're going to be able to get that refinance at a rate that makes your debt service work.
I honestly think there's probably a bunch of deals out there where the money that they would get back by stopping to escrow is the broker's commissions to exit at a break even.
Yes.
Right? Like we were just talking before the show about the importance of return of capital right now rather than return on capital. And I think there's some deals out there where owners are going to have to make a difficult decision to just get out, pay everybody back, say the world changed in the last 2 years, and we'll catch you on the next one.
Well, I know Brian and I talk about this 'cause on the deals that we're in. I'm like, I just want my capital back.
If you told me that rates were going to accelerate at this speed, and I wouldn't lose money, just give me my money.
I'll be honest, even if I lost
first.
a little money and not all of it, let's say I got 80 or 90% of my funds back, there's times that there's hills that it's not worth dying on.
Yeah. Sure.
And I'd much rather. I've seen how bad it can get. Mm-hmm. We've seen people just lose all their money.
Yeah. Mm-hmm.
And so there's times I'm like, again, I'd just rather take even money or just even if I took a little bit of a hit.
Yep.
And then I just use it as a tax write-off.
Yeah, exactly. I do want to bring some light into this discussion though, because it's not all doom and gloom.
Sure.
Right. And Brian, you and I were talking about this the other day. We're hearing about deals that are distressed, and we're hearing about deals where there are deadlines in place that require significant strategic decisions to either overcome or avoid.
Right.
Those deals were based on assumptions from 2020 and 2021, right? When I remember seeing deals in 2021, and it was like, just burn off the loss to lease. CoStar says, rents are up 14% year over year, blah, blah, blah.
Forever.
Right? Those assumptions are no longer valid. And I think that there is a yesterday versus today underwriting and deal evaluation criteria that people have to understand, right? We've adjusted our underwriting criteria very significantly to be way more conservative on economic occupancy, economic vacancy, rent growth, cap rates. 3 years ago, I was underwriting insurance growth at 5% a year.
Right.
Now I'm doing it at 15% a year. Right. On entry, on a new purchase acquisition, I am going in underwriting at the full purchase price times the tax rate.
Yeah.
Because that's just what we're seeing out there, right? We just ran into this with our Waco deal.
Yep.
And another Arlington deal that we purchased, right? So you have to look at the assumptions. And if you're an LP looking at a deal, or you're a GP that's looking at a deal, you have to think about the deal on today's underwriting criteria versus 2 years ago. The world has changed. And if you build those criteria into your new underwriting, and you can execute your business plan, you should feel good about that deal, right? But going in, I don't have any deals on floating rate debt.
Sure.
Yeah.
My entire portfolio is fixed rate, and I put my head down at night knowing that all we got to do is operate it and keep heads in beds.
Yeah, I like it. And the good news is that we're seeing, even on the stuff that we're really analyzing, is that the rental demand's still there.
Absolutely.
Right? So then it starts turning into more of the execution of becoming more efficient in the operations.
Yeah. That's right.
Right? And I think that's where over the previous 3 years, you could have the worst operations in the world and still turn a profit and still increase value and then exit and look like a superstar. Yeah. And now it's more of, this is business building.
Right.
And putting that together, we've done the Waco deal is a prime example of you've got, it's almost like running a restaurant. You have front of house, back of house. Yeah. Right, and the front of house is where you go to dine. Yeah. You've got your servers and the hostess and everything else, and the back of house is the chefs and all those other people that I've never been back there on because they don't let me back there. But it's the same thing when you're running these multifamilies. You've got your front of house, which is, in my opinion, the lead generation to attract good quality renters and tenants.
Yep.
And then how do you get them to commit and run that flow? And then the back of the house is you're still going to always have bad debt, right? You're going to have delinquencies. Yep. So how do you handle that? If it's an all bills paid type of property, making sure that stays, you keep those costs as low as possible.
Good luck with that in 108-degree heat in Texas, by the way.
Right?
Yeah. We didn't underwrite for that all the time. So
whoops.
Yes. And so hopefully that's once every 10 years.
Hopefully it'll be really nice for the fall and spring, and it'll offset our electric.
I'm going to tell you, the
Exactly.
Texas Almanac is saying that it's going to be a really wet and cold winter.
Okay, cool.
Okay, good.
Can somebody else read something other than Nick? Because he always finds the dark shit to talk about.
He does.
I'm the type that, here's how I do it, right? I would rather read the worst of the worst so that when I get into it, I'm like, oh, this isn't as bad as what I read.
That's true.
Gotcha.
Right?
That
When
is
I go
true.
to, if you ever go vacation, you don't want a vacation with me.
Okay,
Because
good.
I read all the 1-star reviews. I don't read any of the 5-star. Ask
Anyone
Heather.
says anything negative,
I
Nick
read
is out.
all the 1-star reviews. And so that when I get there, I'm either going to be like, yep, they were right. Or I'm like, no, those people were absolutely crazy. This
way
place
better
is
than
awesome. But if you're preparing for the absolute worst,
Are you the 1-star review guy? Be honest.
I don't leave 1-star reviews.
No.
Really?
Okay.
Absolutely not.
Yeah.
No, because we own businesses. I don't like 1-star
Yeah,
reviews.
that's
I don't,
true.
Yeah, it takes a lot for me to leave a 1-star review.
Yeah, my wife will. She's not a 1-star review person at all. But if we're like at restaurants and the service is like really slow or whatever, she'll just like pull out her phone and start typing a review. And then when the waitress comes back, just make it like really obvious. She won't post it.
Is a 2-star review worse than a 1-star review?
Definitely.
I think it's
That's
more
for the people
honest.
that didn't have balls to put the 1-star.
Yeah.
I think 2-star and 2, like that's really what I look for. If I always think 1-star reviews come from crazy people
Yeah.
that are just going off the rails.
Yeah.
I actually think a 3-star review is worse. I'm like, this dude is being really honest.
Yes. I agree.
This is very mediocre.
Yeah. And by the way, when we look at deals, speaking of just reviews on this is kind of a sidebar note, is that I've never seen an apartment or multifamily deal, if you actually just Google their names, ever have any great reviews.
Agreed.
Right? They're always
so true.
talking trash about the management company. And I'm like, the management company is there just to be able to have a nice place to stay.
Yeah.
But if you don't pay your bills on time, they are going to start hounding you. That doesn't mean that you need to leave a 1-star review because of that.
It's
like,
so true.
This management company is awful. They've been hounding me for my rent that I haven't paid in 2 months.
How dare they knock on my door
Yes.
Saturday morning
Yes.
when they know I'm home?
It's so true. So what does this do? Let me ask you this, right? Because we're seeing this on the LP and GP side, right? What does this do to asset prices at large? If this problem actually ends up becoming really substantial,
Mm-hmm.
and a lot of deals are in this limbo where it might cost more to keep the deal going than it would to just sell it,
Mm-hmm.
how long does it take before asset prices start to have to come pretty far down to get buyers and sellers in alignment? Because if the sellers are facing what could be a ticking time bomb and buyers have nothing but money on the sidelines right now, I mean, does that create a pretty substantial reduction in asset prices?
I think it will impact the market. I don't know if it'll be drastic. I think there's still a lot of deals that are being shopped off market quietly and will change hands. And at least in Texas, as a non-disclosure state, some of those may be able to keep quiet, right? But I think the bigger question is, if asset prices do reset a little bit because of this, to what paradigm? Are we talking 2018, 2017? Or are we talking 2021? Or let me put it differently, purchase price. So if you have an owner who bought a deal at $10 million, forecasted an exit at $13 or $14 million, is in this kind of rate cap pinch where they can't refi, the rate cap's expiring, they can't afford to keep it up, and they call their broker and like, just get me out.
Yeah.
And get me out at my purchase price. So tack on your commission and make my give me my initial investment back. And I'm happy because I now, using today's underwriting criteria, I can go like revolve that capital somewhere, right? I'd be okay with buying assets at 2021 prices or 2020 prices.
Yeah.
Right?
Sure, yeah.
Knowing what we know about running the business and expense management and
Yeah.
how to execute a good CapEx plan and all that stuff, I'd be okay with that.
Well, and if you take the substantial rent increases between 2020 and 2021 and today, rent growth is not nearly on the same trajectory that it was, but we haven't necessarily seen a huge reduction in rental rates. We might see a little dip, who knows? Mm-hmm. But if you're buying at 2020, 21 prices, but you're getting today's rental rates,
I'll do that all day.
That offsets some of the extra costs for sure.
Exactly.
You know,
Yeah.
so I
I think everybody's entitled to make some money, right? There's hard work, there's effort, there's opportunity costs on the capital that they've invested. But, at the same time, we got to be very, very realistic today. And, we kind of deliberate and ruminate off this when we're making offers on properties. And it's like, do you want to be greedy or do you want to get out? Right? Bulls make money, bears make money, and pigs get slaughtered.
Yep.
Right?
Yep.
And I think I really do think that both brokers and sellers are getting a lot more realistic with their asking prices. And I don't know, 3 times, 4 times in the last week and a half when the brokers call me with a deal, they want X, but I'm pretty sure they'll take 95% of X or 90% of X.
Yeah.
Right? And if they're opening the conversation before I've even objected to the price, there's probably more wiggle room. Right?
Yeah, I mean, look, and I get it on the seller side. If I know that I'm in a pinch, I'm still not going to the broker and just saying, "Hey, liquidate," and let them know how vulnerable we are.
Mm-hmm.
So I get it. They're going to try and still get as much money as they can out of the deal. But I think you're right. I don't think this is cataclysmic. I think this is just going to be something that swiftly drops asset prices back to where they were a couple of years ago, potentially.
Yeah.
Which means right now, we had this similar conversation, the other day that you don't want to be you get killed in the stock market when you're only buying when it's going up and only selling when it's going down. You're just jumping on the bandwagon.
That's right.
And all of the deals that we're in or that we're seeing were all bought in an era where it's like, just man, best market ever. Let's do this. Is it the best market ever that you want to be buying in, quote unquote?
Nope.
I would be a buyer. I mean, we are buyers right now, and that doesn't mean we're buyers because we're super contrarian in any way. I think we are at times, but you should always be a buyer of the right deals. And right now, I think it is much easier to project future headwinds and account for those and be conservative than it was in 2020 and 2021.
Yep.
We couldn't have foreseen what was going to happen in 2022 back in 2020. I think right now you can see what the problems are with those deals. You can account for them going forward. And basically all the things that happen along the way with financing and bridge debt and rate caps, I mean, we're seeing it play out in real time. We now have a working education on here's how to avoid those mistakes and do really good, conservative underwritten deals and protect yourself. If things do continue to trend in a weird direction going forward, you can protect yourself. So I think that right now would be the time to buy. And if rates come back down in 2 years or whatever, I'm glad we bought now.
Right.
Yeah.
I'd always be glad that you bought before a rate drop rather than a substantial increase.
But we're also, right, just to clarify that, we are also underwriting all deals with fixed debt assumptions, right? Fixed debt during the whole period.
About that,
With a 4% rate.
When did floating rates even become popular?
When people started to pay crazy prices for shit.
That's what I'm saying. It's just interesting to me that
is it cheaper to get then? I mean, I
don't know if the origination fees are any different. Those are the typical. You're paying your origination, your title, right? All that sort of stuff.
It's when
maybe because they got higher leverage. I don't
higher
know.
leverage,
maybe
and
that's what it was,
because I'm the fact that we have to make a point that we're underwriting everything with fixed rate debt. I mean, as far as I know, up until 2019 or 2020, right, that was just, you either did fixed rate debt, or if you needed a massive lift, you might have done bridge, but you floating.
And by the way, bridge is fixed.
Bridge is fixed, yeah.
Right?
And so you
didn't.
Floating rates were never really a popular thing.
I will tell you with 100% supreme confidence that every time I got a floating rate option from a broker or a lender on a deal, I never once even put it into the model. Never once.
No.
Never once. It's always been fixed. I need to put my head. I got so much shit going on at any given point in time. I want to put my head on the pillow at night knowing that my debt is fixed.
Yes.
Right? And I have plenty of runway on it. And, so I'm part of the Jake and Gino community, and it's 3 pillars of success, right? Buy right, manage right, and finance right.
Yep.
Those guys are buying all fixed rate debt with 10-year terms on it. And they're taking the extra cost and they're building into their underwriting up front.
Yes.
Just so they don't have to worry about it. Because the average market cycle takes between 9 and 10 years to reset. So they're basically hedging themselves while all this stuff works itself out.
reduce the amount of variables that you have to manage in your deal.
That's exactly right. Reduce the risk and reduce the variables.
So it shows on here what just when I just Googled it real quick is why most would go with floating rate debt was because it actually reduced the cost of the loan. So usually lower rates, lower cost to get in.
Just trying to get more juice out of the squeeze, and I get
Yep.
it. But here's the thing: if you got to get cheaper financing to make a deal work, is that
Well, that's
you
what
know,
Brian said on episode 2, right? He's like, people would call up looking for 5 years worth of IO because that's the only way they could make the deal work.
the deal doesn't work,
Right?
You
I mean,
know?
then you're looking at the wrong deal,
Yeah.
you know?
I agree. I think that's why asset prices will snap back to maybe a couple years ago because there's problems with this financing.
But I also think that there's still so much money on the sidelines that if
Yeah.
there is a dip, I think it's going to be very short-lived, right?
Yes.
I agree, and I think that's as an operator, like this is the stuff we try to be keen about, and keep educating people on, because I also think that some of the best times to buy are the hardest to raise capital in.
Yeah.
Right, like it was just massively easy to raise capital in 2021.
Yeah.
Everything's low rate, everybody's doing deals.
People were getting free money from the
That's right.
government.
It's sexy. It's sexy to invest in stuff. Let's go, right? Rates go up to 8%. Everybody sees deals falling apart. Everybody sees the economy and what are we doing? And they go, I need to keep my $100,000 in the bank. But this also is where there's some of the best buying opportunities.
I
So
hear
there's
ya.
an inverse relationship between how excited people are to put money in the market and the opportunity that's probably there.
Completely agree.
Yep.
You know?
It's funny. You just
It's a
as you
good
were saying that, I got reminded of a story. I was in Northwest Houston in like March of 21. I was walking a deal with Mike's brother Kenny, who is like he's a trip, and we're at this very C-class deal. Right, there's like a car on blocks next to the sign in the front as we pull in, and I look around. I'm like, look at all these new cars, and Kenny says, they all just got their COVID money.
Yep.
And like people were just spending frivolously.
I was talking with my barber about this, Jeff, yesterday.
Be careful what you admit on the show.
No, we're talking about just inflation and stuff. And I went to Mexico in like 2018, 2019 or something like that to a adults only resort. Just in the middle of the summer, normal, whatever. And then I went back in like August or September of 20, and it was like 10 times as crowded.
I can imagine, yeah.
Yeah.
Because everybody's
Is this
going
the
to
same place that you sent us pictures from a few months ago where
No,
you're in your
down the
Speedo
street.
dancing in the pool?
Similar vibe. Similar vibe.
If you sign up at deepbluere.com, we will send you that picture of Brian in his Speedo.
Similar vibe. But yeah.
Text Speedo.
It was,
Yes.
it was just insane. It was like everybody got their check and was like, "We're going to Mexico." It was 10 times as crowded. It felt like during a
I
pandemic.
saved my money.
I don't think I got any money. No, I got some money.
I got a little bit.
I got a little bit.
Yeah, we got a little bit.
I actually
Yeah.
want to say I gave it to our VAs.
Yeah. I mean, what I got scared of back then was that PPP money, because I was like, and we're now seeing people going to
Bro, that
jail.
realtor. Who was that realtor?
Yeah,
Pulled that out-
Miami.
Yeah, that Miami realtor. She had like $350,000 in PPP.
Oh, yeah,
or
I
something. She's
saw
going
that,
away
yeah.
for 3.5 years.
Yeah. Does she get to keep the stuff though?
Good
Oh
question.
man, that's a good trade-off.
She's going to
Like,
come
you-
out and be on Real Housewives or something.
Yeah. So if you
Yeah,
got
that's the thing.
$350,000, you got to go buy some stuff, or maybe you made some investments.
Yeah.
Is it worth going to jail for 3.5 years?
By the way, we don't want that money, so
Yeah,
we're not that desperate.
we'll make it. Put it here
We'll
on the
be fine.
podcast. We're
Yeah.
not trying to.
I think all
commit
that
any
money's
sort
gone,
of,
by the way. Yeah.
fraud.
Look, so Matt just retracted that we were not wrong.
Nope.
So we will never have to admit that
just
we're
didn't
ever
finish.
wrong.
Yes, we just didn't
Yes.
finish the sentence.
Yes.
Right. So it's not just the bridge debt looming over us. It's these floating rate caps that could expire during the hold period that could put a little bit of pressure on the market. But if you're like us, we're going to leverage that as buying opportunities.
Yep.
We are very well capitalized. Our deals are performing very well. I just want to be really, really clear about that to everybody. Like the deals that we are sponsors of are performing very well. One of our recent acquisitions, we're shooting for 100% occupancy by the end of next week.
Yeah,
Right?
Got our call tomorrow. I think we're almost there.
Yeah. The deals that we purchased in 21 and 22, all performing very well. We're executing the business plans, and dividends have not stopped.
Right.
Right? Like, I want to say that again. The deals that I'm a sponsor of with these guys and with some other partners, those dividends continue to pay. and will continue to pay because we underwrote very conservatively, and we're super transparent about the state of the performance of these assets.
100%.
Perfect. Well, that was a good one.
That was a good one. Check out tourstudios.com if you want to
Remember,
do a good one of your own.
Text best beard ever, or go to deepbluere.com, say contact us with best beard ever in the subject line, and get yourself a discount from Jesse for Tour Studios.
Boom. That's
And then,
TORE Tour Studios.
Episode 12, we're going to have the apartment queen on.
We are.
Yeah.
I'm super excited. Kaylee is a fireball.
Yeah.
She is awesome.
I was reading her bio. I was like, all right.
Yeah.
All right.
She's
I see you. I see you.
She's the real deal.
Yeah.
Yeah, looking forward to that.
So episode 12, leave us a review. If you're consuming this on YouTube, hit that subscribe. Just make a comment as well. Like we watch that all the time. And then if you're listening to this on Spotify or any podcast related platform, just you can subscribe there. And if there is an option to leave reviews, please do so 5-star. Because look, you're like us. You're not a 1-star person.
Definitely not. This is not a 1-star podcast.
Yeah, you might read the 1 stars, but you're not one that leaves the 1 stars.
Yes.
Yes.
Smash the subscribe button, as my kids' YouTube videos say all the time. Smash the subscribe button.
Smash that subscribe button.
I think they need to destroy that subscribe button now. And we'll see you next week for episode 12. We have Kaylee on, the apartment queen.
Boom. Thanks, guys.
Deuces.
Bye.
Peace.